I'm Richard Hunter, Head of Markets, and obviously we've had a pretty interesting 2019, so the purpose of this brief chat is just to have a look at some of the, what could potentially be some of the issues for the year ahead. So you will see this, I'm sure, elsewhere as we get nearer to Christmas, but we're looking for 2020 vision. And in terms of just a few of the themes that we expect to be coming along, they certainly will be reducing. What might be reducing we'll come to in a moment. But there's been a lot of talk both in the UK and the US, and I will flip-flop between those two markets for obvious reasons as we go on, of recession. Certainly in terms of the US, earlier part of 2019, there was an increasing feeling that recession was coming around the corner. So far, although the manufacturing part of the US economy is looking a little weaker of late, of course the US economy is very much dependent on the consumer, and there is no sign of consumer spending slowdown there. There's also, of course, the small matter of a presidential election next year in 2020. It's on the 3rd of November. And as we've already experienced since President Trump was inaugurated, his tweets are certainly market moving. I think it's fair to say that as time goes on and as we get nearer to November, he will be pulling out all of the stops to make the point to the American people just what a wonderful statesman-like president he's been, but more importantly, how good he's been for that US economy. Debt is the next issue. Clearly in the current environment where we've got historically low interest rates, debt is perfectly serviceable, both by individuals and by corporates. And in fact, it has, in terms of leverage buyouts, for example, encouraged a lot of corporates to go ahead with that lending. The problem potentially around the corner is what is known as shadow banking. It's basically lending by the non-traditional banks, if you like, and one particular geography to keep an eye on there would certainly be China. And of course, US and China has very much been a central theme over the last few months of this year and will no doubt carry on into next year. In terms of gamesmanship, as I mentioned, it wouldn't be a total surprise if the real breakthrough was made towards the end of part of 2020 as we approach that election. But in the meantime, we have seen markets fairly much turn on a sixpence as we've had feedback both from the American side and the China side on, number one, the fact that we're going to very quickly get into a phase one agreement. That now seems to have been delayed. It implies there's going to be a phase two agreement, and clearly we haven't got to phase one yet. So there are more tariffs also due to come through in December. And of course, when you've got the world's two largest economy potentially at loggerheads, the knock-on impact for the rest of the global economy could be fairly severe if it isn't negotiated to the correct conclusion. Company earnings was a big worry. We've just finished the third quarter earnings season, and certainly in terms of the UK, they've been reasonable. I'll come to that in a moment. And again, in terms of the US, they have beaten expectations. Around 75% of US companies have delivered a better result than was expected. And of course, it's very important when we get company results coming through, not just in terms of the financials and how companies have been reporting for the last 3 months, but equally what their outlook is in the immediate and medium term in terms of 2020. And there's nothing too concerning there just yet, but it's a very good canary in the coal mine. Income, of course, as I say, very much we're in a historically low interest rate environment. There is a chase for yield. It isn't necessarily to be found in the traditional bond market. But if you look at the FTSE 100, for example, whilst the UK is certainly not the most popular market globally, in fact it's been called uninvestable by certain international institutional investors, the average yield on the FTSE 100 as we speak is around 4.3%, and that's obviously significantly more, albeit with a slightly higher risk than you might find certainly in cash. So we've got negative interest rate policy potentially coming back into focus. We've already got a few markets in NIRP, and obviously Christine Lagarde, who's recently taken over the ECB, is seen as being something of a fan of that particular environment. Notably, And interestingly, although it's not likely to change in the shorter term, President Trump seems to think that the US is at something of a disadvantage by not having it. We've seen what he's been saying publicly about the Federal Reserve, so the pressure will stay there. Whether the Fed reacts to it remains to be seen, of course. And that leaves growth versus value, which I'll come to in a moment, because that's a matter of some considerable debate as we speak. So what's going to be reducing? Well, will it be a reduced appetite for risk because of all the issues that we've just been discussing? Or will it actually be a reduction on pressure? Because some people are saying at these new record highs that the S&P continues to nudge, for example, surely these slightly stretched valuations are basically liable for some kind of profit taking. Whilst there are historically comfortable somewhere around 15 times earnings, the US companies are generally speaking keeping up with the earnings part of the equation, as we've just discussed, the third quarter reporting season. They did manage to keep up. So as long as the earnings keep coming through, be that by new growth or by continued rationalisation and cost control, then obviously there is further for this market to go. Bull markets don't die of old age. They change. They run out of steam when something changes. So we remain to be convinced on that one, because what we're seeing at the moment is, despite all the geopolitical noise, all the political noise, the US economy is in very rude health. So in terms of growth versus value, what we've been seeing for the last decade or so is any number of things which have contributed to growth stocks outperforming value stocks. And those are some of the reasons there. I won't be reading through slides as we come to them, but clearly we've seen a boom in share buybacks, for example. As we mentioned earlier, it's quite cheap to borrow at the moment, which tends to fire up the M&A. And we've had some fairly large M&A deals coming through. Now, the other thing that comes into the growth versus value equation is that traditionally it very much depends what part of the economic cycle we're in. Value stocks tend to come into the back end of that curve, so somewhere around late cycle to recession. The question, of course, with the Fed at the standby, prepared, it would seem, to inject more adrenaline into the US economy as we move along, let alone the fact that we've got this presidential election next year, and we're going to get to hear a lot from President Trump. There is a current misunderstanding of exactly where we might be on that cycle. It very much looked 3 or so months ago we were late cycle, but with the Fed on standby, we could actually be mid to late cycle at the moment. Now that would basically tend to suggest that growth isn't going to fall out of favour at this moment in time. Is some of this growth more structural? Well, obviously we're seeing more use of technology rather than the traditional cyclical. We've already mentioned NIRP, and as things currently stand, the consensus estimates for next year and corporate earnings remain fairly positive. On the other hand, of course, if you are of the opinion we are rather nearer the end of that economic cycle, then we're going to get to these valuation concerns, and that's going to start worrying some of the growth investors, because as we'll see in a moment, value investing has been out of fashion for some considerable time now. We've mentioned the trade war between China and the US already. Certainly in terms of China's own global growth, or its own GDP, it's running at a mere 6% or so at the moment, which of course many other developed countries would very much give their right arm for, but it's nonetheless a rather lower number that we have become accustomed to in the recent decade or so. So again, these are very much the bearish points at the moment. Certain surveys suggesting that recession risk is at an 8-year high, although, as I say, at this precise moment in time, we haven't actually seen too many of those examples coming through. So has the time come for the return of the value stock? Value stocks tend to be typified by lower price stocks, not necessarily tied into their intrinsic value. They tend to be the more dour stocks. Perhaps they look like they're going to be paying high dividends because they are more established on the whole, as opposed to growth stocks, which, if you take the likes of the technology sector, for example, are clearly looking to reinvest any income or profits, and that's worked exceptionally well, of course, for the likes of Amazon. So in terms of the fact that they're less risky, that's why you would expect them to see something of a return as we get into late cycle. And if you look over the last 10 years or so, what we've got here is the growth index being the blue one, the average of stock markets in general in the middle, and that's the black line there, how value has underperformed. And it's estimated that 75% of that underperformance for value stocks has come from the banking sector, in much the same way that the majority of growth outperformance has come from the technology sector. Now, in immediate reaction to that, of course, would be that if the banks are currently undervalued, what might be the catalyst to change that? In normal circumstances, with the net interest margin being so low at the moment, the amount of money banks make between borrowing and lending, the first thing that you would have to say is a rise in interest rates. We've got some important inflation numbers coming up in the next week or so, particularly in the States. It's unlikely at this stage of the economic cycle that we need even to be talking about interest rate rises. Nonetheless, it remains a possibility, as does the fact that perhaps after famously getting their houses in order since the financial crisis, banks, and UK banks in particular, are in pretty good shape. So the next question there, of course, is in terms of value, have they been beaten down too far? So just keep an eye in terms of the fact that this is a matter of much debate in the industry at the moment. And equally, if you look over the last 2 to 3 weeks, it's clearly not time to say that a trend has been established, but over the last 2 to 3 weeks, value has been outpacing growth. So we think that very much could be a theme for 2020. Finally, if in doubt, as we often say to our customers, this graph goes up to 2016, but you get the point. If you look at the long-term nature of investment, the dip there in the mid-1970s was the oil crisis. The great market crash of 1987 barely registers on that graph, and indeed the dot-com boom and bust of around the turn of the century. Equally, in terms of long-term, what's the problem? Even the financial crisis of 2008 to 2009 has already been recovered. So you will hear a lot of noise, you will hear a lot of background, but hopefully you may get some solace from thinking about the longer term.